Welcome to video 26 in our series Principles of Equity Investing. You'll remember in video 23 we talked about the theoretical background about asset-based valuation, more particularly the net asset concept. We had also defined the concepts like equity using the fundamental accounting equation there. And we are going to build on that same video, taking some concrete examples so that you are able to appreciate the context of that valuation method. So let's get going. The agenda for this video is quickly refresh the concepts of net asset based valuation so that you don't have to necessarily go back to that entire video, but those who are interested in refreshing the concepts in greater detail, I would definitely encourage you to have a look at that video in greater detail. And the examples that we are going to take today as a part of this video is in the context of how do we calculate book value per share, how do we calculate price to book ratio. So that will be our example one. Then another example which is valuation based on replacement value. One more example based on valuation using the liquidation value principle. And of course, I'll talk about the context of both these valuation methods at that time. And lastly, an example on NAV based valuation of holding companies. So again, I'll talk about these holding companies opportunity one more time. I have of course spoken about it in a couple of other videos, but just to help you to refresh it, I'll again talk about it. So quickly refreshing the net asset based valuation concept, you will remember that we talked about the fundamental accounting equation, where on the left hand side we talk about the sources of funds, which is equity plus non-current liabilities plus current liabilities, and the uses of funds on the right hand side of the equation, which is non-current assets plus current assets. For those who are interested in the details of these concepts, I had also in video 23 provided links to my videos on the balance sheet, etc. So please do have a look at those videos for your quick reference. And when we tweak this equation a little bit, where we move two terms on the left hand side to the right hand side, they change their sign from plus to minus, the basic arithmetic rule. And therefore we can define equity on one hand, which is non-current assets plus current assets minus non-current liabilities minus current liabilities, and therefore equity in another sense is also the net assets of the organization. When we say net, net always means something reduced from something else. So gross assets, which is NCA plus CA, and from that we reduce the liabilities, which are NCL and CL, and that gives us net assets, which is also the equity. And you will remember in that video I had also mentioned that for an individual, when we are not required to keep accounts, we can also arrive at our own equity using this simple method, and I would encourage you to do that at least at the end of each financial year. Every 31st March we should have our net asset or equity position at an individual level, which is a good idea, and we should see whether year after year our net assets are improving. So equity is from a corporate perspective, which keeps of course the books of accounts, and we can therefore derive equity directly by looking at the share capital plus other equity. Other equity consists of retained earnings, which in the yesteryears was called as reserves and surplus, and the second element is share premium. So that's how we can derive equity. We are going to see this with examples. Book value per share. So how do we get book value per share? We derive book value based on the equity number that we just now talked about. So equity divided by number of shares will give us the book value per share. And then we can calculate the price to book. Whatever is the current price divided by the book value per share will give us an idea about price to book. So replacement value, liquidation value, and NAV, there is a difference in their calculation. They do not go by the books of accounts, but they actually are driven by the economic value. And the context of economic value will keep on changing depending on what are the circumstances in which we are doing that valuation. So we will talk about the economic value concept in the respective examples. So we will now go to the examples one by one and see how we can calculate all these numbers that you can see on this slide one by one. Let us now look at real life data to calculate book value per share and price to book. Again, this is real numbers as on 31st March 2019 for a publicly listed company in India. I don't want to talk about any specific name, but the reason I'm taking actual data is just for you to get a feel of how in reality the numbers work. So this is the data. You can see that assets are listed followed by equity and liabilities. So assets, we see non-current assets and then broken down into current assets. The non-current assets in this company are significantly their plant, equipment, property, and also some of the strategic investments that they have made in subsidiaries. Plus there are a number of current assets that they have, and those have been financed out of equity and liabilities. So we can see the equity number here, which as we saw in the previous slide has actually two elements, the equity share capital and other equity. So we can look at these two together to arrive at the equity of the company. And then we also have non-current liabilities and current liabilities. So now let us see how we can calculate the book value per share and then the price to book ratio. So on the right hand side, you will see that the book value per share is calculated. Let us assume that the face value of this share is 2 rupees, and the data which is given to us is equity, share capital and other equity. Collectively that totals to 52,550.72 crores of equity. The number of shares, how do we get the number of shares? That data is not available on the financial statement. But if you look at the equity share capital of 280.55 crores and divide that by the face value of 2 rupees, we will be able to arrive at the number of shares. Because finally, what is equity share capital? It simply means the face value multiplied by the number of shares. And we can therefore derive the number of shares in the reverse way, dividing equity share capital by the face value. And then we can get 140.28 crore number of shares. Now, how do we get the book value per share? We divide the equity by the number of shares, and thus the book value per share as on 31st March 2019 is 374.63. Of course, the company is profitable, and therefore we can even estimate the book value per share as on 31st March 2020. We would be able to also get some data as of 31st December 2019, but for convenience sake, I have just used the published audited financial data as on 31st March 2019, the previous year end. Now the price which is prevailing on 13th of April 2020 was 860 rupees, and therefore we can see that the price to book ratio is 2.30. I had mentioned when we talked about the price to book framework, I had mentioned that a ratio of 3 to 4 is considered quite normal. Of course, there are circumstances in which the price to book can substantially exceed. I had also talked about those circumstances in video 23. And there are circumstances, particularly during market slumps, when the price to book could be even a fraction of 1, substantially less than 1. And that clearly tells us that there are buying opportunities during that time. Of course, because of fear factor, not many people are able to use that opportunity. But that opportunity surely exists. So in particular share that we are talking about right now, the price had even slumped to less than 700, and therefore you can actually see how the price to book at that time would have been even more attractive. It would be somewhere in the range of approximately 1.7 to 1.8. So very, very attractive at that time. So we could have definitely bought shares at that time considering the price to book, but it is never too late and those opportunities keep on arising. So I hope this gave you a good idea about the book value per share as well as the price to book ratio. Let us go to the next example. Let us come to example 2, friends. So here we are going to look at valuation based on replacement value concept. Now you may remember that in the video in which I had explained these valuation approaches, I had mentioned that typically replacement value theory gains momentum during a massive bull phase. So people try to justify how a particular stock is valued far more, uh, and the logic given is that if you were to set up another similar company with similar facilities, it would cost X multiple of whatever is the prevailing value of the enterprise. So, of course, we have to use that data with a lot of caution, but nonetheless, we should be aware about the argument which is involved in the replacement value principle. So here again, there is a balance sheet which is provided to you, which has equity, non-current liabilities, non-current assets, and current assets of a hypothetical company. Now, some more data is given to you on the right-hand side. The replacement value. So what is replacement value? Is the cost that one will have to bear today if you were to exactly replace whatever facilities you have right now. Now that would mean that you buy land, you set up the factory premises, you buy the requisite machinery and so on. And of course, you may make the suitable adjustment in terms of the life, which may have already expired. So if you were to actually replace it on a like-to-like basis, it would cost today 2,500 crores rather than what you can see on the left-hand side as 1,685 crores. Then in the non-current assets, you also see others, which are investments into other companies, which may be strategic stakes, and their value would be 250 crores, let's say. And assume that the equity share capital, which again you can see on the left hand side, which is having value of 100 crores, consists of 10 crore shares of rupees 10 each. Now in this situation, we can easily calculate the book value, and the book value comes to the total equity, which is 100 plus 1,400 divided by the number of shares, which are 10 crore shares, and therefore we can get the book value per share as 150 rupees per share. Now, how will we calculate the equity on replacement value basis? Again, we use the same formula of equity being equal to NCA plus CA minus NCL minus CL. Now here, while replacing the or while filling the value of NCA, we do not take the book value. We do not take 1,685 and 153 that you can see on the left hand side. Instead, we would pick up the value of 2,500 crores plus 250 crores, which is 2,750 crores. We pick up the total of current assets because current assets typically have a short-term life, and therefore it is assumed, though it is not explicitly stated, if they were to be replaced, they would have similar value. And therefore, if we take a collective total of inventory, receivables, and bank balance, we would get 2,424, which is the same amount that we have taken here also. And similarly, from that we reduce the non-current liabilities and current liabilities, which are at the same amount that you can see on the left hand side, which is 1,850 and 912. So using this replacement value, we get the equity of 2,412, not 1,500 that we had got from the books. So 2,412 divided by 10 crore shares will give us replacement value per share of 241.20. Now let us say if the prevailing price is 180 rupees, then one could clearly get into buying this stock using this argument of replacement value. Now, as I mentioned here, this was just an example. Typically, when replacement value argument is used, we are already in a solid bull market, and that's where the prevailing price would have already risen significantly more than the book value, and the replacement value per share may be even larger than that. So that's where people get enticed into buying such shares which may have a significantly more replacement value. But I would also say that this argument can be used for our own benefit when the market is going through a very rough period, and at that time stocks are getting hammered, the prices have significantly fallen, and at that time, if there is a business potential for this business and if the replacement value is significantly high, then we can use the replacement value argument to in fact aggressively buy that share, which may even be trading at a price less than the book value, or even if it is more than the book value, the replacement value could be significantly more. And during this corona pandemic time, we clearly can identify such companies which have solid investment in non-current assets in the form of property, plant and equipment, land, which is being used in that current business. And if that was to be replaced, it will cost significantly more. And we can therefore, with a lot of confidence, use this replacement value argument to our own benefit during tough periods also. So, to sum up, replacement value argument during solid bull phases has to be taken with a pinch of salt, but replacement value as an argument during stress periods of the market can be used to our own advantage, and we can aggressively buy those shares. So I hope the principle involved in this was clear to you. Let's go to example 3. Example 3 is not based on replacement value, it is based on liquidation value. So what is the difference? Replacement value assumes that the business has a great potential or it has a bright future, and therefore replacement value argument is used. The company is functional and definitely it has a potential to create a lot more economic value. In case of liquidation value, as the name suggests, maybe the company has come to a halt, not much is happening, but it may have solid assets which can be sold and can be actively used by somebody. Now, liquidation value argument is never given during solid bull markets. Liquidation value is an argument that we can use for our own benefit in the context of strong bear markets. What I mean by bear markets is where the stocks have fallen rapidly, and in that scenario, to check the worst situation, we can use liquidation value. So replacement value will typically give you much more value as compared to liquidation value. But liquidation value gives us the minimum comfort. If those assets were to be stripped or sold as they are, maybe if land was to be auctioned, the property, plant and equipment was to be sold off, somebody were to dismantle it and take it away, then what is the liquidation value that we can definitely get? Now, if the prevailing price is even lower than that and a fraction of that, that gives us a comfort. But then this is clearly a speculative buy because the company is not functional. There may be some other reasons such as high debt, high borrowings, which the company is not able to repay, etc. So therefore use this with caution. Now we have similar data, but here you will see that the liquidation value of property, plant and equipment is much lower than the book value. Similarly, here, luckily the other investments whose value can still be realized because they may be shares traded in the market. So there the value could be more than what is stated in the books. But the core assets, which is your infrastructure, is going to be liquidated at a much lower value. Similarly, when you get into a distressed sale of inventory and you try to collect receivables in a hurry, you may not be able to realize the entire amount, and therefore even those values are less than what is carried in the books. Again, we assume the same 10 crore shares of 10 each as can be seen in terms of the equity share capital, and the book value comes to the same number as example 2, which is 150. Again, we replace all the values of NCA, CA, NCL and CL, and that's where we notice that the liquidation value per share is significantly lower as compared to the replacement value. So here again, we have used the liquidation value of inventory and receivables, and of course bank balance we would be able to realize at the same value. So therefore, you will see that NCA is simply the total of 1,000 and 250, 1250. Current assets is a sum total of inventory 1,000, receivable 725, and bank balance of 440. And current liabilities and long-term liabilities would be the same. So in that case, we find that the liquidation value is much lower at 653 crores, and liquidation value per share is 65 rupees 30 paise. But now suppose imagine, because of the bad news surrounding the company and generally the bear market, if suppose the share is trading at only 10 or 15 rupees, it could be a great speculative buy. But you have to use this with a lot of caution and make a limited investment in such risky shares. Now we'll go to one more example, but which is in the context of holding companies. So in case of holding companies, here we have this example of NAV or net asset value. Now net asset value is similar to book value except that the assets are marked to market. So what is the meaning of mark to market? They are all valued using prices available from the market. Now this data that you see on the left hand side is different from the data that we saw in example 2 and 3. So this is hypothetical data again, and as you can see in non-current assets, the bigger part of non-current assets are investments made by this holding company. Now what is a holding company? Holding companies are typically created by promoter driven family groups which hold this company as an instrument for acquiring or holding shares in multiple other group entities. Again, to stay away from specific names, I am not taking any names, but you will find many such companies practically belonging to different industrial groups in India. So all the objective of this company is to hold stakes in different companies. It may not have substantially its own business. Now, here we have to calculate what is called as the net asset value, and this is similar to a mutual fund in some sense, but as I have mentioned in the video talking about these valuation methods, holding companies do not get a price which is equal to NAV. If you were to do a transaction in a mutual fund, the transaction happens at the NAV at the end of the day. But in case of a holding company, because holding companies are inefficient from a tax perspective as compared to a mutual fund, there is usually a holding company discount. We'll see that in this example, that the NAV works out to a certain amount, but the prevailing price in the market is much lower than the NAV. Now, just because there is a discount, we should not rush into buying, because this discount is usually going to be there because of tax inefficiency for holding companies. Of course, that is also changing in India with recent changes in the tax laws. So they, in my view, may become a little more efficient than what they have been in the past, but they may not be able to still match the efficiency level of a mutual fund from a tax perspective. I'm not saying from a performance in the stock market or return perspective, I'm simply saying from tax perspective. So how do we then calculate the NAV? Here, let us assume that this investment that we see of 403 crores in non-current assets actually consists of 3 strategic investments in 3 different group companies, company A, B and C, with holding of 1 crore, 2 crore and 3 crore shares respectively, with the current prices of 200, 250, 150 respectively. The share capital of the company consists of 10 crore shares of face value rupees 10. I'm talking about the holding company. I'm not talking about ABC individually. So now how do we calculate the NAV of this company? NAV is essentially the equity as derived based on market values of the investment portfolio as adjusted for other current assets and non-current and current liabilities, and essentially that is divided by the number of shares which have been issued to derive the NAV per share. So here you will see that the aggregate NAV or aggregate equity based on valuation of the investment portfolio based on the current prices works out as follows. So NCA consists of two components, property, plant and equipment. So we don't have any access to what the market value of the property, plant and equipment is. So therefore, I have assumed that right now to be the same, which is 55. But the value of 403 has been replaced by the market value of the three stocks that the company owns. What I mean by stocks is shares. So 1 crore into 200 is 200, 2 crore into 250 is 500, 3 crore into 150 is 450, plus 77 of current assets, which are short-term investments and bank balance, and we reduce from that the non-current liabilities and current liabilities. So now we get the aggregate NAV or equity of 1027 crores. If we divide that by 10 crore shares, then we get the NAV per share of 102.70, and the market price prevailing is 60 rupees, let's say. So there is already a discount of 41.6%, which is a reasonable discount. But what happens interestingly about holding companies is that during bear phases, the discount can expand to 50, 60. I have even seen it expanding to more than 70%. Now that is abnormal. And in such situation, why not invest in holding companies rather than invest in companies individually? So why not invest in this holding company rather than investing in company A, B and C? Now as the market recovers and share prices of A, B, C also recover, the price of this company, which is the holding company, will also recover. Not only that, it is quite possible that the discount may shrink from the current 70% to 40%, and we can take advantage of that as well. So why not take advantage? So you'll have double gain. The NAV itself starts going up, and secondly the discount shrinks. So therefore personally I use holding company route quite aggressively as a defense mechanism to market vagaries. So friends, I hope you like this video. If you have, don't hold back your emotion, press the like button, subscribe to the channel, share your comments and share the video with others so that others will also benefit, and suggest topics in the comment section of the video. I really appreciate your patronage. Thank you so much.